Look at these markets go. Look at these markets go. Just before we go, while we're waiting, you can see the moves. That's gold. Big gold again. Last few days. Didn't enjoy that move yesterday, though, did it? Okay, then. Let's go. Let's get going. Thank you very much for joining. Thank you very much indeed. Superb to see so many of you coming back. That's the most excellent thing, is so many of you coming back and joining us on a daily basis. That's excellent. I love to see that. And it gives us, what is key in all of this is knowing that we're doing something good for you guys, and knowing that this is helping, and that's what we want. So as long as that continues to help, that continues to be the case, then we'll obviously keep going. But let's get to the markets now. We're looking at moving averages. For those of you who are new, not come to any of these seminars or webinars before, what we do and how we do this is we run these webinars. We look at the markets, of course, coronavirus, and we're all on lockdown, and coronavirus is dominating our lives, and we're not doing anything away from being in our own house. So it's good to update you guys on what's going on in the markets. You can see across all of these charts that there is big moves happening today. So what's key is that I give you an insight into what's going on, and then we add an educational aspect in. Now, today's moving averages. So I'll be giving you a little bit of an insight into moving averages and exactly what goes on with them and how they work. And then after that, we kind of look at how the markets go. Sometimes we go for half an hour, sometimes we go 40 minutes, sometimes we're a bit longer, sometimes we're a bit less. But obviously it depends on how we go. Yesterday, I think we went for the longest that we've ever gone for. We were almost an hour yesterday. But I try not to keep you for too long in these things, so I know we don't all have a million hours a day. Right, so let's go. Let's look at these markets. The Dow. Let's start with the Dow. Actually, I don't want to start with the Dow. I want to start with cable, because the market made us look silly, and these economic announcements made us look silly, because we saw this breakout. It was very strong. Before we go any further, I do just want to say to you, of course, any questions that you do have, please send them through. Please send any questions that you do have through, and we will go through. I'll answer anything that you go through. Yesterday, we had a lot of people asking to see various different things. So please, anything that you do have, please get in contact with us. Now, we've been derailed in terms of cable by economic data. Economic data has finally reared its head. It hasn't been doing it before, and it's been largely ignored, which has been really one of the key things. It's been largely ignored by markets and investors, and we just haven't necessarily seen much reaction to some of these bits of data. And usually, to be perfectly honest, the reaction has been the complete and utter opposite way to what we've expected. We have seen moves one way, and we've seen really negative economic data, and then we've seen markets really fly. But today has been the first time, excuse me, here's my cough again, the first time that economic data has sent markets really aggressively lower. Okay, the first time that we've seen that. And we're now trading on cable after breaking through that big upside level, 24.85, the blue level in there, you can see. We broke through that, but now economic data, and that economic data is the number from retail sales. Now, I said to you yesterday that the retail sales numbers were going to be important, and those of you who watched my video earlier this morning, I did preview this for today and said, look, economic data is going to be key today, and the reason it's key, the reason that we're starting to look at it, is because this retail sales figure today was for March. It was for March. Now, previously, we've seen this data. It's been for January, February, Q1. Okay. Now, that hasn't given us any information because it's pre-coronavirus. The data set that we're getting doesn't have any of the aspects of coronavirus in it. But now we're seeing retail sales for March. That shows massive sell-offs. This is why the initial jobless claims have been so important, because they're weekly. There's more information. There's more of a data set around coronavirus within that. Now, at the moment, we're not seeing that situation. Now we're seeing this data is for March. March was hit by coronavirus, and that's why the market has suffered. It is really, really selling off aggressively. So, and the reason the dollar has gained, and this is obviously sterling against the US dollar, and the dollar index has jumped aggressively higher. Now, the reason for that is because bad economic data takes the stock market down, pushes the dollar higher because of the safe haven aspect. That's why we saw gold move. Okay, oil is also coming off that little bit further. So that safe haven aspect, investors want US denominated debt. And that's where they go to. They fly to that US dollar. And that's why we're seeing this big gain in US dollar, sell off in sterling, in cable here. So it's disregard. And this is what we said before. It disregards the technicals. It disregards the technicals and does send us into this situation. So let's clear this down a little bit, and let's add our moving averages, because remember, our moving averages are the key point of what we're talking about today. And I'll show you how I like to do those. So let's get rid of some of these objects. I do just want to delete. We can delete them all and we can add back in, because I do want the fib back in. So let's put the fib in. Here we go. From this high, the high to the low down here. Oh, no, wrong one. My apology. We're going this way. Press the wrong one, this high. This is the high we used. Of course, it's the more relevant high than the high from the start of the coronavirus move. There we go. Okay. So 124.85 was the key one. No, what am I doing here? I've put the wrong one on again. If I could start doing this correctly, then we'd be halfway there. Please excuse my butterfingers from today. Okay, there we go. So the 124.85 figure was the key one, and the 61.8 was the key move to the upside. And the key thing that we the key movement that we had here was a breakout of this situation. Now, what we do from a moving average point of view on a daily chart is we look to have longer term averages. Now, there's three I like to have on a daily chart all the time: 50, 100, and 2% and 200 standard moving averages. Okay, so these are the ones that I like to have: 50 or 55. Some like 55. SMA, and SMA stands for standard moving average. So that's one. Next one is a 100 period SMA, and the other one is a 200 period SMA. They're the three I like to have on: 50 or 55, either one, or as well as the 100, as well as the 200. Okay, so we can use them in a number of different ways. Right. So this is so we add them on through our chart. So let's go in and add them on. This is how we add them on. We go in here. We go in. I have a question. I have a lot of questions coming in here. Where are the questions? A lot of questions. What's the difference between exponential moving average, weighted, and standard moving average? Well, the key ones that we look at are EMA and SMA. So EMA is an exponential moving average. Okay, so sorry, standard moving average. So basically, the difference in EMA and SMA is the sensitivity each one shows to the changes in the data, and that's the data used in the calculations. Okay, so that's the difference in the calculation. So if the SMA, what basically a moving average does is it calculates the average price data and then smooths out the period. So it takes, whatever data you select, if you select a 200 period moving average, it takes the data from those 200 period moving averages and averages it out and then plots that on the chart. Exponential gives more weight to the near-term data than it does to the other data. Standard moving average gives basically the same weight to everything. So it's a very versatile way of trading. And we go to insert indicators, and it's on your MT4 or MT5. it's a trend following indicator because it follows the trend, right? So going here, trend, same as our Bollinger Band. Remember, the Bollinger Band has a 20-period moving average in it as well. And then we go into here, moving averages. So 55 is what we have initially. So we're going to add our 55. And it's a simple moving average, simple standard moving average. Okay? So simple moving average comes in 55. Now, I like to add the other ones. Insert, indicator, trend following, moving average. Now I want a 100-period moving average. I'm going to change the color. I want it red. There's our 100-period moving average. And now I want to insert my 200-period moving average. Trend following, moving average, 200, simple moving average, change the color, blue. Okay, so there are our three. There are our three. So we have our three moving averages, and you can see they're jumping around. They're trying to cross over. They're trying to look with each other. They're trying to do a slight. They're trying to do various different things. We look at them in various different ways. Okay. Now we can look at them. Number one, from a point of view of how a trend should look. So let's find something that's trending, shall we? Let's find something that's trending quite nicely, not giving us any cause for any concern. What's trending? What's trending on a long term? Nothing really trending on a long term, is it? I'll tell you what might be trending on a long term, stocks. And we've got key examples of this at the moment, haven't we? Because it is earnings season. Let's look at Apple. Chart window. Just put my template on there. Okay. Let's enlarge this. Go on the daily chart. That fell off quite aggressively as well. Trying to find something that isn't selling off very aggressively. So let's insert our moving averages again, indicators. Now you can add, obviously, once you've done this, you can add your add this to a template. But let's add that 200-period moving average, and let's add the 100 in as well. Indicators, trend following, moving average, 100. There are quicker ways to do this. I like to do everything from the top to show you how easy it is from there. Right, so the way a market is supposed to look on a trend, the way the markets are supposed to look in a key uptrend is this. You're supposed to have, and this is how we point out a key trend and if the market really is trending. We are supposed to have three separate things for a good uptrend. Number one, price action must come first. Number two, the short term, and by short term we mean the lowest number, so the shorter term moving average, which is here, then the longer term moving average, which is here, the middle moving average, then the longer term moving average, which is here. So there's four things, and that points to us being a perfect trend. So this is what we see from this point of view. In a perfect trend, we see price, 55, 100, 200. That's a perfect trend. Now, our first sign that markets are going to turn around and that the trend is completely changing here is a break. Now, a break of Apple below here was our first sign. That would be a selling signal, and the market sold off. So a move, we wouldn't have been able to catch any of that because this is Apple. This is a strong company. Company has been moving so incredibly strongly for such a long period of time. The market breaks below one, breaks below two, negative, negative, negative. Market moves up, okay? Then comes back up, but this is such a short term. This is such a big erratic movement, so it's hard to gauge. So, but we see sell signal, but the market comes back. But it holds up, not at the high, not at that high level, doesn't come back to trade at that high level up here. It comes back and stops itself at the moving average. And this is another way our moving averages act. They act as support and resistance. So this 55 period moving average is now, in this situation, acting as a support level. Resistance level on the upside. Let's say it right. So in a perfect trend, we have price 55 SMA, 100 SMA, 200 SMA. Okay, that's what we get in a perfect trend. And that's what we've got here. So our first sign of something going wrong is a cross. And this is when we look for crosses. And we look at a cross here. This is our first cross. First sell signal comes in. Now, this doesn't have to be on Apple. A good thing about moving averages is they're very versatile. You can use them on pretty much anything. So they are versatile. So the breakout here comes in, and this is what we see, okay? But of course, they can give us false signals. And the way everything gives us false signals sometimes, and the reason that we get false signals is because of volatility, massive amounts of volatility. You can't gauge a lot of these movements in just one technical piece of technical analysis. They have to be slightly different in other areas. So the market fell from this high, broke below, and then we started seeing it act as a form of resistance. So we saw the market broke through, and when it came back, it instantly started acting as resistance, and it instantly started acting as resistance here. So 2 touches there, and the market went down. It broke back below here. Another break there. Even though if you look at this is what's interesting, right? Markets are breaking, but they're gapping. So the market gaps are enormous. And even though this candle is so much lower, it's still a green candle. Again, lower candle, green candle. Lower candle, green candle. So the markets are actually trading up on the candle from the opening price, but they're much lower than where they are when they're expected. Remember, stocks gap. Stock markets gap, and they gap because you have a definitive open and close price. So if a market opens and then closes and then something happens overnight, and we've seen this all the time, the open then is a long way away, which is why stocks have been so erratic like this. So resistance. This then acts as resistance here. The 100 period. Markets moved lower. Now we're coming higher. Broke below the 200, hit the low. Now we have the low in. We have our low point, so we have another level. Our level is down here at this low. $212.49. Our high point, $328.03. We've got earnings coming out. The earnings for Apple, I think, are on the 5th of May. So now what we see here is we start to see this, a cross. But this is a strange situation. We don't see this very often at all. And what we're seeing here is a complete contradiction. So what we're seeing here is a 3-way cross. Now, usually we talk about the death cross. Usually we talk about a death cross, or we talk about a golden cross. Okay, now there's 2 different things in here about what they exactly do. Now, a death cross is when the 50 period or 55 period, which is the purple one, breaks below the 200 period moving average. That is a very, very bearish signal. That signals an absolute reversal in our trade. I can see a few questions coming in. I will answer your questions. I promise you I will answer your questions. Let me just get through this bit, then I will answer your questions. So the breakthrough comes, a death cross is when this moves down here and breaks below that. So what we would want to be seeing from that point of view, and a death cross requires a red arrow, is if we see this. That goes there, and then this comes here. That then is a death cross. So we're looking at the 55-day crossing the 200 period moving average. And remember, for a perfect trend, we want to see this over here. That's what we need to see for a perfect trend. And if these are crossing, we don't have a perfect trend. Now, in this situation, we very, very rarely see the price moving back above as these are crossing. Now, this is the crossing of the 50 and the 100 is a bearish signal. It's not as bearish as if the 55 crosses the 200. That is even more bearish. That is the death cross. And that points us to markets coming lower. However, this is now starting to move higher. So stocks are moving higher, breaking through these upsides. So you can see the situation here is very confused in terms of stock markets. And that's because things are too erratic. The movements are too much. Okay, we've got too much in the way of big moves. Okay, we've got too much in the way of big moves. Moves are far, far, far too erratic for us. So this is the situation. It's far too erratic for the moving average that we have here. But a death cross would be here, if that breaks down lower. Now, there's nothing to say, and this is something I've been saying a lot of times over the last few days, is that markets are rallying in a very strange way. They're rallying in a very, very strange way. And usually we get a situation where the market gives us these signals in a very different way. Okay, so this would only happen if the markets are turning round. But what could happen here is this could give us usually we'd say this is a selling signal, but not with the price coming back through. Because remember, if the price is then above that, this means that this 50 period moving average is going to tick higher as well. And when that 50 period, remember, it's a lagging indicator. So when that ticks higher, it takes it back above the 100. And we're in a situation where we're back in a perfect trend again. Even though it would look very congested in this area, this is not giving us a perfect selling signal. Now, if the price comes off from here, the 50 period moving average moves lower and crosses below the 200, then we get the death cross. Then we're in a very negative selling signal. But the markets are reacting very strangely, aren't they? They're reacting to coronavirus data about the health aspect, whereas they should be reacting to the economic aspect. And that's the point. And we will cover onto that in a second when we then go and look at the what happened in terms of these retail sales numbers. So this is the similar issue that we've had here. This is not acting. Also, this 55 period moving average is not acting as a resistance level on the upside either. So the move, 1, 2, move, breakout. Okay, so that breakout there is saying bullish because it's going back through here. So very mixed signals. We would not be selling into Apple at this point, even if people would be. I don't think anyone would be selling into Apple anyway at the moment. Okay, still looks cheap. Still looks cheap. Not to say market's not going to move lower again, but still looks cheap. So the situation is interesting from our point of view there on Apple. Now let's get rid of this. Let's just delete this. And let's come out and look at our stock markets again. And let's add our moving averages. So Wall Street, this was our situation. Again, it's playing around with this 50 period moving at this 50 fib, isn't it? It does not like it above that 50 fib. It has not once closed above that level. Remember what we said. Remember what we've been saying for the last few days. Confirmation. Have we had breakout of these levels? Yes. Have we had confirmation? No. The candles have not been closing. No confirmation. The candles have not been closing above. They've been pushing above only very slightly, but they have not been closing above. And that's very interesting, okay? Because it shows us that there is an economic impact behind this. And then the market falls today because what? Retail sales comes out and it shows that a fall of 8.7% in retail sales. 8.7% is a massive fall. Okay, a massive, massive fall. That causes us huge issues in the market. But now that also tells us that finally the market is looking at economic data, because remember, the economic impact of this is going to be felt far after the health aspects. Once everybody who has recovered is recovering, and everybody who gets it, who sadly is going to die, has died, then when this returns, the economic impact hits so much harder. It was the record 1 month fall to 8.7. Prior was a fall of 0.5. And let's look at how some of these things fell. So auto and gas fell 3.1%. Excluding autos, it fell 4.5%. What else was down? So clothing and clothing accessory stores were down 50%. 50%. Food and beverage stores were up 28%. Now that was hoarding. Remember, we had hoarding, we had hoarding, we had panic buying. All of that stuff has pushed food up by 50%. 28%. Motor vehicle and part dealers down 25%. Electronics and appliance stores down 15%. Health and personal care stores up 4%. So that's drugs, antibacterial, toilet paper, things like that, up 4.3%. Gasoline stations down 17%. Non-store retail, so online, is up 3.1%. That's smaller than we would have expected. Department stores down 19%. Food service and drinking places, so restaurants and pubs and bars, down 26%. And that will likely increase the negativity when we see April's figures. So that's going to fall. Let's get to some of your questions in here. What is the reason behind investors and traders opting to the dollar-denominated assets, and as COVID-19 seems to currently take a highest toll on the US? Well, the reason for that is because the US dollar is the world reserve currency. Everybody, you just have to look in Kenya. What currencies do you trade in? Yes, you have Kenyan shillings, but US dollar is what you also trade in. Okay, people want US dollars as well as Kenyan shillings. Okay, so if you look in other areas, it's exactly the same. Even here in the UK, if you don't have UK pounds, you have US dollars. So people want US dollars. And it becomes a self-fulfilling prophecy as well, because markets go higher on the back of, stock market, US dollar goes higher on the back of these things. So it makes people want them more. So the more people buy them, the more people want them. It's a market demand thing. So so that's why we get the US dollar denominated debt go higher. And that's why we look at US treasuries as well. That's another one. Yeah, airlines also sell tickets in dollars. Absolutely right. What will you consider when choosing the period when using the moving average option? So moving average, let's get back into our moving averages just quickly to show these. Let's add our ones on here. Now, there's so many different forms. People look at different ways to add moving averages. Okay, so a lot of people like to add shorter term ones on shorter term time frames, but I use moving averages as a long-term indicator. So I will only have them on longer term charts because it will give me a good indication of what was going on. Now, what I want to show you actually is what happened on this US dollar, on the Dow Jones, and more importantly on the S&P around the 55 period moving average, because that was a key one. And it wasn't a 55-day moving average, it was a 55-month moving average, which is even more long-term. So the longer term we look at these, the more important they become. And you can see this situation here, can't you? And let's see, I wonder if we've had a death cross on this yet. Where is it? Where is it? Where is it? We've had the death cross. See, we've had the death cross on the US stock markets, and it was down here. Now look where this 50 period moving average is and the distance between these two. This shows us that, okay, these markets may be recovering. These markets may be recovering, but they're not done yet. Look at the distance here. To get a perfect trend, what do we need? Price, 55, 100, 200. Look at the distance between these two. And in fact, we are in downtrend territory. in perfect downtrend territory because we have price 55, 100, 200. Perfect trend, just a downtrend. So someone said, what's going to happen when the 50 moving average crosses the 200 line? It's already crossed it. It crossed it over here. It crossed it over here. And in fact, we look at it, it crossed it as markets started to come higher. Yeah, it crossed it as markets started to come higher. So you can see, oh no, it's a bit further back. So it's around here, around this sort of time. And then markets have recovered. But look, this is not holding up. It doesn't enjoy it up there. This market has more downside to come. Now let's look. I want to add this 55 period moving average. And I think I may already have it on there. Hang on a second. I think I may already have it on there for, and we'll finish up in a moment. But I think I might already have it on there for the S&P. Let's get to the S&P. I know some of you have a few more questions. I will answer them. Someone asking me here, what causes market gaps in the stocks? Well, I'll cover that in 1 second. God, this is slowing down. Come on. S&P, S&P, S&P. Where is it? Here it is. Bang. Okay, let's go monthly. So let's add, we want the 50 period moving average, indicators. There are quicker ways to do this, guys. I'm showing you the slowest way to do this. 55, it's blue. So look what happened in this situation. Maybe it was weekly, not monthly. Maybe it's weekly. No, it was monthly. Okay, so this is the situation. This is what we saw, right? So the markets were moving to this situation, okay? We then went up to here, and this was key. This broke through the 55 period moving average and closed. You could see here that it tried it. Back in July 2018, bounced higher. This time it sold off so aggressively, broke through it. It's now moving higher, but we know we're under the impression that this is a situation where this is not going to continue this upside. When the economic effect comes in, it's going to be key. But look how many times 55 period acted. It followed the Bollinger Band. It bounced off of it from this point of view. The movements are key. The movements are stark. They're really, really interesting in terms of what we're seeing here. Okay, really, really interesting. Okay, and this breakout here was a key break. Yes, it's come back higher, but look how low it did go. On a break of this, look how low it did go. Okay, so it's really, really key to break below that. And again, we're not looking for confirmation on a 55 period moving average on a monthly chart because we could be waiting ages. Okay, but we did see that break. If this confirms back above it, which I don't think it will, this is looking more negative. Okay, we're looking monthly, we're looking long term now. Why does stocks gap? Well, stocks gap because they have a definitive close and open. Okay, so if you take, for argument's sake, there used to be a famous example of this. There used to be a betting company in the US. I can't remember what it was called now, but there was a betting company in the US, and it closed one day at say $200. It closed at $200, and during that session, we saw after that breakout, we saw overnight there was some information released. So market closed at its end date at a certain time, and it closed at 200 pence. Overnight, after the market had closed, information came out that said that this betting company was no longer going to receive payments from credit cards to its accounts. So that wipes out half of this company's database because half of their clients deposit via credit cards. And you're no longer allowed to do that. So, but remember, this news is announced and the market is closed. So the price can't move. So at 4 p.m. on say it's Monday, on 4 p.m. Monday, this company can receive payments via credit cards. At 8 a.m. the next day, it can't. At 8 a.m. the next day, 50% of its client base is gone. So the price has to reevaluate. So what happens on the open? The market gaps, because it's no longer worth, the company is no longer worth $200 a share. It's now only worth $100 a share because there's been a breakout. So that's why these markets gap. That's why we see gap. Someone asked me, what's the ideal gap in moving averages when dealing with currencies? I say 50, 100, 200 works on everything. Doesn't matter whether it's currencies, doesn't matter whether it's stocks, indices, they work for everything. What's going to happen when the 50 moving average crosses? We spoke about that one. So guys, that's the sort of movement that we get. That's the sort of stuff that we've had going on. It's a really busy time again at the moment, but our markets, this is my question to you all, and this is what could happen. And think about this until you come back tomorrow. And of course, we want to see you back tomorrow. And remember guys, one thing I have to remind you of, next week, our Instagram Live, myself and Kevin Nganga, the CEO of Scope Markets, Kenya, we will be hosting an Instagram Live next week. Next week, we're hosting an Instagram Live. Next Wednesday, I think it's going to be 6 p.m. I think it's going to be 6 p.m. Oh, I didn't talk about the gold cross. Joseph, thank you. Thank you, Joseph. I will talk about the gold cross. Let's talk about the gold cross. The gold cross, I'm sorry, Joseph. I apologize. I got carried away. The gold cross, so if a death cross is very simple, Joseph, so going the other way is very simple. But the death cross is the 55 crossing below the 200. The gold cross is when this crosses back above. So it's when the 55 crosses back above the 200. That's the gold cross. Okay, so it's when markets are turning around. So moving averages cross when markets are turning. It's an indicator that trends are turning, and it's a long-term indicator. Okay, so if these do cross, we've seen the death cross. This is still very much in a bear market territory. If this crosses back above the 200, then we get gold market, the golden cross, and that's an indicator that we're turning around the other way. Guys, just want to highlight we do have our. I got told off for going on too long yesterday, so I just want to quickly highlight this. We do have our Instagram Live. Myself and Kevin, the CEO of Scope Markets in Kenya. We will be doing an Instagram Live together. We'll be talking about earnings. We'll be talking about markets. We'll be talking about everything to do with financial markets and trading. And if you want to join us, then this is the Instagram account that I will be doing it from. This is the Instagram account I'll be doing it from. JRH Trading. A lot of you signed up yesterday. I actually didn't post anything yesterday on my stories. I got very busy in the end yesterday. Didn't get to post anything. We're posting stuff a little bit later on today. But JRH Trading, this is where I'll be doing it. Myself and Scope Markets Kenya account, we will be doing this. And I will be live next Wednesday, 6 p.m. 6 p.m. is the time, next Wednesday evening. Hopefully you will get an email, you will get a text to remind you. We'll be talking about indices, we'll be talking about currencies, all of the technical analysis that we talk about. We'll be taking your guys' questions, and we're doing it all live on the on Instagram. So if you do want to do that, please sign up to here. But guys, apart from that, hopefully you have found this interesting again. What are we talking about tomorrow? Oh, tomorrow we're breaking live the initial jobless claims. So remember this initial jobless claims number, which is massive to us all. It's been the most important number. We're breaking that live tomorrow. We're breaking it live. Okay, so tomorrow we'll look at the major number. We'll look live. We'll look what the expectations are. We'll look how the market's going, and we will break the initial jobless claims live. Are we going to see more than 6.6 million more Americans claiming unemployment benefit yet again? That's going to be key for us to look at. So much going on from that point of view. We'll look at that tomorrow. But guys, apart from that, thank you very much for your time, and I will speak to you tomorrow. Thank you very much.